My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Let people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to explain crazy days like today. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Now, look, this market's become real simple. Stocks that benefit from rate cuts get bought. Buy. Stocks that don't benefit get sold. Sell. So after a day where the Dow gained 203 points, a lot of rate cut beneficiaries in that index, while the S&P lost 0.5% and the Nasdaq tumbled 1.28%, not a lot of beneficiaries there. We need to think about who wins and who doesn't once the Fed starts cutting interest rates, something that likely won't happen tomorrow when Fed Chief Jay Powell speaks, but might come as early as September. Fortunately for many of you, there are a lot of rate cut winners out there. Yesterday, for example, we saw McDonald's rally on dramatically weaker numbers. Huh? Well, things have gotten so weak that people are avoiding fast food until the prices come down. Hence why McDonald's rolled out its new $5 meal. Very smart. But this market doesn't care that it's doing badly. It just treats the Golden Arches as a rate cut winner because the company's got some economic sensitivity, certainly more than we ever thought. Now, today's turn is Stanley Black & Decker. The toolmaker's been working to cut costs, and today it delivered a good enough number that investors can imagine how profitable it'll be once rates come down. Investors are dreaming. I like the dream. It's called leverage. Stanley Black & Decker's levered to housing turnover, so it's levered to lower rates because when the Fed starts cutting, you'll see more existing home sales and more remodeling. It's why we have a nice-sized position in it for my charitable trust, which you can follow along by joining the CNBC Investing Club. Hey, the banks work too. They need to start making loans again, and they need economic activity instead of obsessing about how much they make by sitting on your deposits. Hey, thanks to Betsy Grace, the always present Morgan Stanley bank analyst, who pushed the banks hard today, made a big splash, got them all moving. See, she recognized that this is the point in the business cycle where banks can really shine. Plus, they buy back a ton of stock. You know what? We're going to be talking to one of these very banks. One of my favorites, Huntington Bank shares out of Columbus, Ohio, if you stay tuned. The stock's already up 19% for the year as part of the great broadening that I keep talking about. We're seeing the aerospace stocks soar, stocks like RTX, which makes jet engines and services them. Or how about stocks like How I Met Your Mother? Our quaint nickname for How Met Aerospace, we're really funny, which makes fasteners or screws for the aerospace industry. Both RTX and How Met are screaming higher because, as the team from Howmet mentioned on their conference call, aerospace is indeed cyclical. The industry benefits from lower rates because the businesses buying airplanes often do it with borrowed money. So rate cuts are nirvana for them. They help travelers, too, so there will be a lot of demand for planes from airlines. Same kind of thinking is going on for the rest of the industrials, which is why that group is just doing terrifically. Hey, you know what? Oh, that's all fabulous, right? Unfortunately, this stock market, though, is not built on rate cut winners. For years now, it's been rallying on the strength of precisely the companies that don't need to borrow money, that don't need rate cuts. Companies that therefore won't see much of a boost when we get rate cuts. Companies like tech stocks. Yes, tech stocks. They're just very strong businesses with suddenly very bad stocks, at least for now. At the risk of stating the obvious, what we loved about the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, which reported tonight, Nvidia, and Tesla, what we love was that rates didn't matter to them. They had such strong businesses. That's how they could go up for most of the last 2 years. They're the ultimate secular growers, which is why they didn't get dinged that badly by the Fed rate hikes. But the flip side of that is that they won't really benefit as rates come down. The Magnificent Seven, the companies, will be doing just fine, regardless of where the Fed takes interest rates. But their stocks, very different story. The answer is their stocks are and will be losers. And they'll probably keep losing until their shares come down enough to look cheap versus the rate cut winners that are rallying now as part of the great broadening. Now, that could be some distance from here, which is why one of the reasons that when you see a weak number from any tech company, like tonight with Microsoft, sellers just come out of the woodwork and they just blast the darn thing. I mean, it's just incredible. People don't even know how it's doing, and they just sell it. For tech, the watchword is 3 words that my staff loves to be able to say. And those 3 words are, get out now, which is a fabled reference to something that I did when, if you ever read Confessions of a Street Addict, I should have bought all those companies and crunched them, except for I wrote it. Consider the case of Nvidia, which is doing amazing things with generative artificial intelligence, generative AI, and accelerated computing. Those are the two biggest trends of our day. Those are basically their own cycles with their own rules, and they have nothing to do with the Fed. That's something we love them for. Not anymore. That's how Nvidia stock has become a wasteland. I mean, it's this interstitial gunfire. I mean, every day. I mean, thank heavens that the market stops. Thank heavens they ring a bell. Because then it can stop going down. Okay, sure, it's still up 110% for the year, but it's now down more than 35 points from its high, 140 to 140. I don't see it stopping here. That's not because Nvidia's business has deteriorated. Its products are selling amazingly well. Its competitor, AMD, on tomorrow and Squawk of the Street saying good things. It's because Nvidia doesn't benefit from rate cuts, so its stock gets kicked to the curb in this environment. The money you get back from selling the company's shares that are being redeployed are to the rate cut beneficiaries. No insult to Nvidia. It's about the stock, not the company. So why not get rid of the stock? Because Nvidia stock is getting cheaper as it goes down. Right now, the street expects them to earn $3.59 per share next year. But if this is anything like the Nvidia we've seen in the last decade, those estimates are probably way too low. Maybe so low that the company could eventually earn $4.59 per share next year. In that case, you've got a stock that's conceivably selling at less than 23 times next year's earnings. I am not selling the greatest growth stock of our generation at 23 times earnings. I'd rather risk taking some pain. And maybe then, keep in mind, Nvidia is the premier growth stock of our time. I'm going to say it again. It's not going down just because skeptics feel there's no good return on investment AI. It's going down because Wall Street's become a lot less willing to pay up for the earnings of growth stocks. It's called multiple contraction. Right now, investors would rather chase cheaper stocks of companies that will get a massive earnings boost from lower interest rates. Think Stanley Black & Decker. Wall Street at certain junctures falls out of love with great growth stocks, abandoning them for cyclical stocks that will do much better in accelerating economy. The year-over-year comparisons are just much better with these rate cut beneficiaries than they will be with the Mag 7. The market runs on these companies. But at some point, a stock like Nvidia gets so cheap, so darn cheap, on an earnings basis, can you believe it, that the selling will stop? We just haven't reached that level yet. I don't mean to be picking on Nvidia. Microsoft, Meta, Amazon, Apple have all been experiencing multiple contraction. Meanwhile, stocks like Stanley Black & Decker or the banks are experiencing multiple expansion. Glorious. Now, we hear that many smaller cap stocks are winning here. It's the big techs donate share to them. Donation is a very tricky word, though. What's really happening is that big institutions aren't doing anything different than they usually do. They always sell the stocks that don't need the Fed to make the estimates and buy the stocks that will put up huge year-over-year earnings growth with the help of rate cuts. Of course, there are stocks that are basically bits and bobs. Procter & Gamble and Merck missed the numbers today. I can tell you if it weren't for China, those stocks would have actually gone higher. I'll go over China losers later in the show. Eli Lilly keeps going down because it's been up a lot. It suddenly has GLP-1 competition. But it's also suffering from the same multiple contraction as the Magnificent Seven. We don't know when that will stop either. Quality company, real bad stock. It's so easy to just dump all the great growth stocks that have done so well when you have cycles based on cell phone refresh or PC refresh or AI or accelerated computing. You sell them and you will feel so instantly relieved. You'll be like, oh, a steamer trunk removed from my back. Never forget, though, that you're selling winners, actual bona fide winners for stocks that were losers just 2 weeks ago. Selling winners for losers is indeed a longer term a mug's game, unless you think this rotation has immense multi-year staying power or you're a hedge fund with the ability to flit in and out all day and all night. For the Charitable Trust, we've trimmed many of the amazing winners of this year to buy hitherto losers like Stanley Black & Decker. We could bask in the win, if only because but you can't because we still own so much of the Magnificent Seven. But like politicians, we must ask ourselves, are you better off now with the cyclicals than you were with the secular growers? The answer, here's the bottom line. You're not better off if you only own the cyclicals while waiting for the rate cut cavalry that never came and still hasn't come. But unless you think that Nvidia's general custer, you should come out ahead when we fully discount the rate cuts that are ahead, even though there could be plenty more pain than we have so far had with the great broadening as it unfolds. Let's go to Wayne in California. Wayne.
Hey, booyah, Jim.
Booyah, Wayne.
You are the man. Thank
really?
you
I'm the man?
Thank you for helping so many families across this amazing country.
Wayne, thank you. You know, you don't feel like you're helping people when you see Microsoft drop or Nvidia drop. So when I speak to Wayne in California, I suddenly think maybe I'm not a total dope. How can I help?
Well, I need your help. Uber earnings are August 6th.
Yeah.
Why has Uber dropped so much in the last 2 weeks? And what do you think is going to happen in Q2?
Okay, Uber is trading as a function of a multiple contraction. So in other words, what's really going on here is people are just willing to pay less for the losses that Uber might have. And when that occurs, what you have to do is just kind of hold your nose and hold it if you think it's going to be a great growth down the road. And that's what I think it's going to be, a great growth stock down the road. Take a look at the way Airbnb managed to get through a couple of declines. That's what I think can happen with Uber. You need to stick with it. But it's nothing to do with the business. It has to do with the stock. Let's go to Georgie in Pennsylvania. Georgie.
Hi, Jim. I've been a member of your club since its inception, and I cannot thank you enough for the education.
Thank you. We're trying so hard. Jeff and I are trying so hard. Zev putting out great stuff, and I really appreciate it because now we know why we do it. We do it because of you, not because we just necessarily think we're, like, really great. We're just trying to help. So thank you.
Well,
How can I help you?
It's not only education, you are growing my investments, and that was the goal, right?
Yeah, you know, I should have retired years ago if I felt that I didn't have anything to contribute. I had a lot of things I want to do in my life, but I like this club, and it makes me feel good because of people like you, Georgie, okay? I can do a lot of other things in my life at this point, and I just like helping people. No cynicism.
Thank you for what you do.
Thank you.
I have an important question to ask you, Jim. When I retired, I started 3 custodial accounts for my 3 grandchildren who are now 16, 15, and 13. And with the intent that when they graduate from college, they'll have a nest egg. And I transferred, all the years I worked, I held on to Disney. So my cost basis for Disney was $31.31. I transferred 100 shares into each of their accounts. However, as you know, the day it transferred, it reflected differently. And they are reviewing their accounts with me, which I love, you know.
Right.
But here's the thing. I know hopefulness is not a strategy. I want to believe in Disney, but I'm perplexed on whether to let that lie in there or cash it in for what will look like a loss so they won't have to pay taxes.
Right.
And invest it in something else.
Okay, so, Georgie, here's the way I have to think about this. We care about the fundamentals. We don't care about taxes. Here's what you need to know. Disney traded all the way up to 120 when Nelson Peltz got involved. I think it can get there ultimately, but I wish Peltz had gotten in. By the way, I was totally right, and so was Nelson. So I'm really tired of hearing about the belly aching from the company. The company screwed up. It's got to do better. If it doesn't do better, it's going to be on the firing line. And there's nothing wrong with that. If we were talking about the Eagles and they dropped 5 games at the end, you think I'd be happy? And my trust owns some Disney, but it doesn't own any of the Eagles. Don't get swept up in Fed rate cut rumors. I think as this rotation continues, you got to stay focused. Remember which stocks are proving winners in this market, and don't give up on all of them. You can give up on some or take some profits, but not all of them, please. On Mad Money tonight, the IPO market is showing signs of life, and last week we got one of the players in the occupational health space that we want to take a closer look. It's kind of interesting. It's called Concentra. Then copper has spent the last 2 months melting down, even though people thought this would be a super cycle. What does the commodities price action mean for stocks? I'm going off the charts to find out. And just ahead of tomorrow's Fed decision, I'm hearing what Huntington Bancshares has to say about a timeline for potential rate cuts when I sit down with the CEO. Thank you so much to the callers for saying such good things. It was a very trying day. And stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.